In this lecture, I want to talk about the long strangle strategy. Now, strangles are very similar to straddles. They have a lot of the same characteristics, but they're structured slightly differently. So for a long strangle, you basically buy to open, an out of the money call, and an out of the money put. So for example, if the stock's trading right at 50, you might buy the 55 call, which is out of the money, and you might buy the 45 put, which is out of the money. And again, you're going to use the same expiration for both the call and the put. Now remember that a long straddle uses the same strike price for both the put and the call, and you're usually constructing that right at the money. Whereas a long strangle uses two different out of the money strikes. So I thought I'd show you a chart just to sort of clarify this. So here we have the classic Shake Shack example. Before earnings, Shake Shack was trading right at around 84, which is right here. And so in the previous example from the long straddle, we bought a straddle right at the money, right at 84. And so we bought the call and the put right here at 84. And so we were betting on a move up from that point or down from that point. That's a long straddle. And again, the long call and the long put will both have the same strike price. A strangle is when you separate these two. So if the stock is trading at 84, we might buy the 88 call for a strangle and the 80 put. And so you can see that rather, if we'd done it as a straddle, we would have been right here in the middle. As a strangle, we stagger it. We do a little above where the stock's trading and a little bit below where the stock's trading. So hopefully that visual is helpful. And now, just like a long straddle, a long strangle will make money if the stock makes a big move in either direction, either up or down, and also if implied volatility increases, which we'll see when we take a look at the Greeks. What's the max profit for a long strangle? Well, it's unlimited, and that's mostly because of that long call. Stock could go up a lot, that call could get deep in the money, and you can make a lot of money. Likewise, if the stock falls a lot, the long put will go in the money, and you'll make a lot of money on the downside too. Though of course it's capped at 0. The stock can only go down to 0. And similar to the long straddle, the maximum loss for a long strangle is just going to be that debit again times 100, times the 100 share multiplier. Upper break-even price is just going to be the long call strike price plus the debit paid. Lower break-even price is the long put strike minus the debit paid. We'll do an example of this so it'll make more sense. And so what we see here is you need a really big move to get you not only past that strike price, but also far enough where you pay for that debit as well before you can start making money. So if we go back to our chart, you can see that whereas with a long straddle, if the stock makes a move, the call or put immediately starts going in the money. Whereas here, the stock has to not only go from get to the point where that call starts to get in the money, but it has to go up enough as well to pay for the cost of the strangle, the cost of the call and the put. Now, because you're long two options, you're long a call, you're long a put, there's no assignment risk. You only get assignment risk when you're short options. And similarly to a straddle, in a strangle, if you hold it into expiration, that long call, and the long call is in the money at expiration, you're going to end up long 100 shares of the stock. And likewise, if that long put is in the money at expiration, you're going to end up short 100 shares of the stock. And obviously, just like with the straddle, only one of these things can happen. The call's going to be in the money or the put's going to be in the money. Or maybe if the stock's between those two strike prices, the strangle will just expire worthless. And again, I would emphasize, just like for the straddle, there's usually no reason to hold a strangle into expiration. So instead, to exit, you just sell to close both the call and the put. And you can do that separately. You can leg out of it, or you can do a single transaction. So let's quickly go. I'll show you how to enter a strangle. So we're going to go to Microsoft here. We're going to look at the December 20th, 2019 calls. Microsoft is currently trading right at it's at 144.54. So let's call that 145. So we're just going to go 5 points up and 5 points down. So we're going to buy, to construct a long strangle, we're going to buy the 150 call, and we are going to buy the 140 put. Now you can see that the cost of both of these, it's going to be a debit, and that debit is 2.64, $2.64, so $264. So you can see that again the stock's at 145, and then we're going to be buying the 150 call above it and the 140 put below it, and you can see it costs $2.64. Then to continue this trade, you just press continue, and you can execute the trade, and you'll be long a Strangle. I wanted to show you an example of what the price difference between a Strangle and a straddle, because in the case of a long Strangle, you're buying two out of the money options, an out of the money call and an out of the money put, so they tend to be a little bit cheaper. On the other hand, you need to have, as we saw here, you need to have a bigger move for them to make money, but the initial debit, the initial entry price is cheaper. So let's just remember this number for the Strangle, $2.64, and we're going to compare that to an at the money straddle. So we're going to use the same expiration, but instead we're going to buy an at the money call and an at the money put, and you can see that the at the money straddle is going to cost us $6.35, and so that's about call it 2.5 times what the Strangle would have cost. And so straddles tend to be more expensive, but they have a higher probability of making money. So these are the two things you have to sort of weigh, and you also have to think how big of a move you're expecting the stock to make. So before I forget, we'll quickly go into Thinkorswim. We're going to do the same trade here just so you know how to enter it. We're going to look at Microsoft. We're going to look at the December 20th long Strangle. So the stock's currently trading at 145 roughly. So we're going to go over here to the call side. We're going to right click and we're going to say buy a Strangle. And then again, we're going to want to adjust this down to just one contract on each side, or however you want to size it. Now the stock's currently at 144, 145, and so we're going to actually change the strike price here to make it 150, just as we did before. So you can sort of toggle here, and you'll see we'll be doing the same thing that we did in Robinhood. We're going to buy the 150 call, we're going to buy the 140 put. The debit looks roughly similar. I think it was 264, this is 257 roughly. And then you just click confirm and send. That's how you do it using Thinkorswim. So again, no reason to ever hold a Strangle into expiration, just like a straddle. So here we'll do an example. Let's say the stock's at 100. To enter a long Strangle, we're going to buy the 105 call, the next strike price up, and we're going to buy the, this should say the 95 put. So we're basically buying it out of the money call, out of the money put. The call is going to cost us $1.10. The put's going to cost us 95 cents. So the total debit for this long straddle is going to be $2.05. We just add up those two premiums. In other words, it will cost us $205 to enter into this trade. And again, I want to point out that a Strangle will almost always be cheaper than a straddle. I would say it would always be cheaper than a straddle. So a similar straddle, if we did an at the money straddle here, right at 100, it would have cost closer, using the same implied vol and everything, would have cost closer to 570 instead of 205. So more than twice as expensive. Now, what's our upper break-even price for this trade? Well, we just have to take the upper call strike price, 105, and add the debit to it. So if the stock goes up to 107.50 right at expiration, we will break even on the trade because we will have gone past the 105 call strike price by the amount of the premium or the debit that we paid. So that'd be the break-even price on our trade right at expiration when there's no time value left on the options. And then the lower break-even price will just be the put price minus that debit. So 95 minus 205 or 92.95. Again, a Strangle's going to be cheaper than a straddle, but also a lower probability trade because those options, the put and the call, are both out of the money. So as we said, we have this range between the upper break-even and the lower break-even. So if the stock price is anywhere between 92.95 and 107.50 right at expiration, right before expiration, we don't make any money. That's sort of the range where we don't make any money or we break even. But let's say the stock does end up making a big move. It moves from 100 to 110, and we're close to expiration, so there's really no time value left on the options. At that point, the 105 call is going to be 5 points in the money. It's going to have only intrinsic value, so it'll be worth 5. And the 95 put will be completely out of the money. It will be basically at 0 because we're right before expiration and the stock's at 110. So that 95 put will be close to expiry and worthless. So the value of the strangle at this point after the stock has made a big move will just be the price of the call plus the price of the put, so $5. And we remember that it cost us $2.05 to enter this trade. That was the debit. But here we can sell the long strangle. We can sell the call, sell the put. And in this case, you just don't even need to waste time selling the put. Maybe you won't even be able to collect any premium for it, but you'll definitely be able to sell the call. And so we can exit here at $5 for the long strangle. It costs us $2.05 to enter the long strangle, and we can exit here at $5, so we make 144% on our money, which is pretty good, but it's not as good as you might think, because if this trade had gone bad, we would have lost 100% of our money. And so not a bad return, but you've got to always keep track of what the downside is as well. Now, what are the Greeks for a long strangle? Very similar to a long straddle, except for the delta. Now, the delta, you remember, for the long straddle is usually right around 0 because you're buying an at-the-money call and at-the-money put. The at-the-money call is always going to have a delta of about positive 50. The at-the-money call is always going to have a delta of positive 50, and the at-the-money put's going to have a delta of minus 50. So a long straddle is almost always very close to delta neutral or delta of 0. Same for a long strangle, especially if the call and put are sort of equally spaced out and have similar and opposing deltas. But you can also sort of skew the delta one way or the other. You can skew the strangle. So you could have a slightly more bullish strangle, in which case your call would have a higher delta. So you might buy the call a little closer to at the money and then buy the put a little more out of the money. So in this case, you have a 30 delta call and a 10 delta put, and you just add those together. Again, the delta of a put is negative, so 30 minus 10 is 20. So in this case, the delta of the long strangle would be about 0.2 or 20, in which case it would be a slightly bullish strangle. If the delta were 0, it would be a delta neutral trade. If the delta is positive, it's slightly bullish. If the delta is negative, it's a slightly bearish strangle. Just like with a long straddle, a long strangle will have a positive gamma. And this is just because it's the same reason when stock goes up a lot, your long delta of your long call is going to get bigger. So you're going to get more long the stock, the more the stock goes up. And likewise, when the stock goes down, your negative delta of that long put's going to get more and more negative. It's going to approach -1 or -100. And so you're going to get more short the stock. Theta is going to be negative, as you'd expect, just like with a long straddle, simply because you're long a call, you're long a put. Both of them have time decay. And just like a long straddle, you're going to have twice the time decay of a normal trade because you have these two options that you're long. Vega is going to be positive, just like with a long straddle. And so if implied volatility of the options goes up, your long call and long put are going to increase in value. The value of the strangle will go up, just as it would have for the long straddle. So again, all these Greeks look very similar, except possibly the delta. It can be either delta neutral, like a long straddle, or weighted slightly more bullish or slightly more bearish, depending if you think a stock has a chance of making a big move, but you think it has a slightly higher chance of making a big move to the downside. Maybe you choose a slightly closer to the money long put for your strangle, and a slightly more out of the money long call. So you can sort of play around with this. It's very flexible. That's one thing I love about options. It really gives you so many different ways to express your opinion on what the market's going to do. Now, just like a long straddle, as we said, a long strangle makes a big move and makes money if a stock makes a big move up or down, or also if implied volatility goes up. But if the stock doesn't move and you just sit there, you've got these two out of the money options. They're just going to be bleeding time decay, and you're going to be losing money if the stock doesn't make a move. So just like the long straddle, long strangle, you probably want to enter close to an event that you're expecting to move the market, maybe close to earnings. And just like with a long straddle, if a stock makes a big move, you should usually take profits right away in a long strangle, just because of this time decay. If nothing happens and you're just sitting there, you're losing a little bit of money every day. So we already talked about how to place a trade in Thinkorswim and in Robinhood. So that's the basics of a long strangle. You can think of it as a long straddle, sort of with its legs a little bit more spread. And rather than being at the money, you've got that long out of the money call and long out of the money put. In the next lecture, we'll talk about the inverse of this trade, which is the short strangle.